With turmoil in the banking system and a possible recession looming, there is no shortage of big-picture economic worries for investors these days. The gains so far this year in the S&P 500 and Nasdaq add another concern: that the U.S. market, its performance driven by a small basket of stocks, is overvalued. With these risks in mind, investment experts are looking abroad to Japan and Europe. European luxury brands are expected to benefit from China's reopening, while in Japan the draw is a more balanced stock market that offers access to semiconductor companies. When investors were asked how they'd spend $100,000 on a personal passion, answers ranged from traveling in rural Japan to starting an AI tutoring company to a trip with friends to the Super Bowl. For ideas on how to play the experts' themes using exchange-traded funds. Before looking for new investment opportunities, review your existing portfolio to see if your asset allocation is where you want it to be. And with so much economic and geopolitical uncertainty, make sure you're on the strongest financial footing possible. Global dividend growers expect to see an earnings contraction upwards of 10% and some kind of recession this year. We want to be invested in strong, well-run companies able to generate profit regardless of where we are in the economic cycle. An example of a global sector that is a defensive growth play is the pharma sector. These companies have been able to generate positive returns during the prior 4 recessionary environments. The sector is underperforming year to date but has a really compelling long-term outlook in terms of trends like investing in longevity. The big picture is that we want companies with strong management, strong balance sheets, good cash flow generation and sustainable and growing dividends. These dividend growers, or dividend aristocrats, have been able to outperform in 25 of the last 32 years. There's also a valuation argument for global equities, which are trading at about a 31% discount to the S&P 500 on a forward price-to-earnings basis. And when you look at the composition of global equities, U.S. equities represent 61% of the market capitalization but only contribute 50% of profits. Investors could use 2 lower-cost ETFs to capture dividend growers across the globe. The ProShares S&P 500 Dividend Aristocrats ETF, Noble, is a popular choice, with $11 billion in assets and a fee of 0.35%. For exposure to the rest of the world, the iShares International Dividend Growth, IGRO, would work well. Alternate idea is that we would take advantage of all of the concerts coming up, all the artists who are touring. Taylor Swift tickets are really expensive, so I could potentially take family and some friends to a Taylor Swift concert. It would be amazing. Japan has been a very easy market to hate for a long time. But while you hear a lot of talk about onshoring or nearshoring, a more pertinent trend that supports Japan is friendshoring. The idea is that European and US companies are likely to pivot from their historical reliance on China to Japan for a range of intermediate goods. The strategy is that the tech is the second largest component in the MSCI Japan Index, at just over 15%, but in Japan the stuff they do with chips is not the sexy stuff Nvidia is doing. It's all the stuff that goes through your car, the stuff that tests other chips to make sure they are working. It's the infrastructure of semiconductors, and it's a much better place to access that trend than in China. Also, Japan is the only developed market in the world with a positively sloped yield curve. So, you can borrow money cheaply and lend it out to make a profit, which is hard to do almost anywhere else in the world. The big picture is that Japan is a fascinating market that is much more balanced than the US. No one sector dominates the index as technology does in the US market. Japan also has a broad range of consumer brands that export to the world and that we think will be major players. The Goldman Sachs Active Beta Japan Equity ETF, GSJY, is a solid choice with a fee of 0.25%, though small at $13 million in assets. It has about 14.4% in tech. A more mainstream choice is the JP Morgan Beta Builders Japan ETF, BBJP, which serves up a broad swath of the stock market for a 0.19% fee. What makes us a Japanophile is wood-fired Japanese pottery. Japan has been using the same clay for 15 generations. It's the essence of wabi-sabi, an appreciation that imperfections, change and even decay can be beautiful. It reflects the love of tea ceremony, of traditional art forms, and it dates back to the late 16th century. When you visit, you're in their home, you visit the kiln in their workshop. You are sometimes there for several hours, maybe even having a meal. The last couple of decades have not been kind to long, short managers, as the rising market challenged relative performance. We think the environment going forward will be more advantageous to skilled stock pickers. For more than a decade, active managers really struggled to beat their benchmarks. The opportunity now is for the market to broaden out a bit so that there will be a larger universe of names to pick from on the long and short side. Last year, the playing field clearly tipped in favor of active management, although the first quarter of 2023 was a step backward. As the Fed rolls back its easy money policies, we expect interest rates and inflation to level off at modestly higher levels. Higher inflation, think roughly 3%, is not problematic as long as it's stable. Capital-intensive companies with relatively higher fixed costs may thrive as they regain some pricing power and are able to leverage higher nominal revenues against a fixed cost structure. In our equity allocation, we have a component we call defensive equity. It's been in higher-yielding dividend stocks for years, and we are transitioning that over to this long-short exposure. We also like long and short because it could serve as a hedge against an adverse market environment. Moreover, the allocation may serve as dry powder to take advantage of any distress created by a downturn. There aren't a lot of long and short ETFs, and none are low cost. One of the older long and short ETFs is the First Trust Long and Short Equity ETF, FTLS, which has $651 million in assets and a fee of 1.36%. A newer one is the Leatherback Long Short Alternative Yield ETF, LBAY. The fund has the added twist of using shareholder yield as a screening metric. LBAY has $80 million in assets and a fee of 1.32%. Shifting towards Europe. In every decade, there are some overriding macro themes that are really important for investors to think about. The last decade was about disinflation, and this one will be concerned with inflation that is stickier than in the past, in the 3% to 4% range, and volatile. In this environment, you want to be more sensitive to valuation, and make sure you are exposed to sectors that will do well in a more inflationary environment. We also like companies that can pass on pricing increases. Recent economic and earnings statistics from Europe show much improved growth over early year expectations. Europe has a lot of interesting luxury companies, including LVMH, and China's reopening with an emphasis on a consumer-led recovery should be supportive of luxury franchises in Europe. Chinese tourists are spending and traveling again, and companies like LVMH are well positioned. Also, we think there will be a big industrial revival in Europe. It has an imperative on the renewable energy front, and at some point, it will have to rebuild Ukraine. Depending on the country, valuations are at a 30% to 35% discount to the US market, and trade at around 12 times forward earnings versus 19 for the US. We've been rebalancing from a significant overweight to the US market and into Europe, which has more broad-based sectors that do well in an inflationary environment, whether it's energy or financials or industrials. The value sectors tend to be larger than in the US. A good ETF to use to play Europe while getting increased exposure to LVMH is the SPDR Euro Stoxx 50 ETF FES. The fund tracks stocks from Belgium, Finland, France, Germany, Ireland, Italy, Luxembourg, Netherlands and Spain. LVMH is its second largest holding, at a 7.3% weighting. The ETF has $2.7 billion in assets and a 0.29% fee. Thank you so much for watching this video, and we thank you again for being a part of our community channel. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income and affiliate marketing. I have my affiliate marketing links listed below on this channel. Please click on them now and discover the best affiliate marketing program I am very proud to be a part of, which is onlinebusiness.app. Don't forget to hit that subscribe button, like and comment below, and turn on your notifications so you never miss a video from Passive Income Journey 777.